Managing money, loans, credit cards, mortgages, it can all feel like a bit of a minefield, can't it? But here's the thing, you don't have to avoid them. You just need to understand them. Stick with me for the next few minutes and I'll make it as easy as possible for you to understand what the key things are about each of these financial tools that you really need to understand. Have you ever been offered a credit card with a seemingly amazing interest rate? Or maybe you're thinking about buying your dream home, but you're overwhelmed by all the mortgage jargon. If you don't understand these financial tools, it can cost you thousands. So I'm here to explain each of those in the simplest way possible. Let's dive straight in. Let's start with credit cards. I mean, they seem harmless, right? Everyone's got them, everyone uses them, they just flip it out at the end of a meal in a restaurant and all that kind of thing. But here's the catch. Credit cards can become a financial trap if you don't use them correctly. And to use them correctly, you need to know how they work. First, let's talk about interest rates. A credit card company might offer you a fancy, shiny 0% interest rate when you first take it on. But that might just be for a few months, maybe 6 months, maybe 12 months, maybe even 24 months. But once that introductory period ends, you could be hit by increasing to anything up to 20% or even more. If you carry a balance after that 0% interest-free period, then your debt can snowball really fast and it could take you much longer than anticipated to pay it off. Next up, it's fees. Annual fees, late payment fees, foreign currency transaction fees, all of that kind of thing. Individually, these fees might seem small, but if you don't take care of them or don't try and avoid them actively, they can build up over time, adding to your debt pile and taking even longer to pay off. They could just increase the amount you owe without you even realizing it. And finally, there's credit limits. Credit cards come with a limit, the maximum you can borrow. But credit cards are not an allowance. Just because you have a high credit limit doesn't mean you need to spend it all. And it doesn't mean you have to get anywhere near it. So for example, I've got a £50,000 limit on one of my credit cards. But how much do I spend on it every month? Something like £1,500? It's nowhere near the limit, and I don't intend it to be, because the limit is a limit. It's not what I intend to spend every month. And on other credit cards, I have a smaller limit, but sometimes I don't spend on it at all. For example, I use a Halifax Clarity credit card when I'm spending abroad, but most months of the year I'm not abroad and I don't spend anything on it at all. In fact, maintaining a regular balance that's too high, too close to your credit limit can actually impact your credit rating. And this makes it harder to borrow money in the future when you really need it. The bottom line is use credit cards wisely. You should never be putting money onto a credit card, putting debt onto a credit card that you can't pay off in full every single month. Now, yes, there are some times when this becomes necessary, but still bear in mind you are paying interest on anything you don't pay every month. Even if you are paying the minimum balance, the minimum amount that you have to pay every month, it means the rest is incurring interest. So you're not getting away with it scot-free. Keep your monthly balance well below your limit to maintain a healthy credit score. Right, that's the basics for credit cards done. Now I'm going to go on to loans. Whether it's a personal loan or a car loan, understanding the terms is key. Loans come with an interest rate, just like credit cards, but typically loan interest rates are lower. And I'm talking about the interest rates here because loans typically have a fixed period. You have to pay back that amount plus the interest over a fixed period of time. So whether you take out a 2-year loan or a 5-year loan, you need to understand how much your monthly payments are going to be. And more importantly, how much the total cost will be. And here's a trap. Some lenders might offer you flexible payment terms. Just bear in mind that sometimes that flexibility can cost you more in the long run. If you extend your loan period, what you're actually saying is that I will take longer to pay this loan back, which means the interest you pay overall will add up. And therefore, overall, you'll end up paying more than if you just stuck with that loan for that shorter amount of time. The key questions to ask yourself when you're taking out a loan of any sort is, what is the interest rate? How long will it take me to pay this off? I.e., what's the term of the loan? And do I anticipate needing to extend the loan? Because then you're playing with different numbers. And are there any hidden fees for early repayments or late payments? For example, I've got a business loan out at the moment, but I specifically went for a type of loan that allowed me early repayment without penalty. So if I come into extra money that's unexpected, I can pay that loan off earlier and I won't incur any charges for doing so. That gives me ultimate flexibility and taking the amount of money that I need for a fixed period of time. And if I want to bring that period forward, if I can pay that money off any earlier, then I do so and I don't get penalized for it. When you take a loan out, you need to know why you're taking that loan out in the first place. You need to be pretty clear on that. And it should be something you can pay off without stretching your finances too thin. And remember, it's not just about the amount you borrow, it's about the total amount you end up paying back, including interest and fees and everything. The worst situation to be in is taking out a loan where you expected to pay back X, and actually because you hadn't anticipated interest, early repayment, charges, late penalties, all of that kind of stuff, you end up paying more. That's the worst place to be in. So if you know all of that up front, at least you're going in with your eyes wide open. Right, mortgages. Here's a quick 101 on mortgages. This is the big one because you typically borrow more through a mortgage than you do from personal loans or credit cards. A mortgage is typically the largest loan you'll ever take out, and therefore understanding the fundamentals is crucial. Again, let's talk about interest rates on this first. There are two main types: fixed rate mortgages and variable rate mortgages. Fixed rate mortgages, this is where your interest rate stays fixed. It's in the name. And your interest rate stays fixed for a set period of time, anything from 2, 3, 5, or even 10 years. And variable rate mortgages, again, it's in the name. They can vary over the term of the mortgage, typically based on what the market interest rate is. Now, choosing between the two different types depends on how much risk you want to take on. If you're someone that really needs some comfort in knowing exactly how much you'll be paying every month, then a fixed rate mortgage is probably better for you. This is for those who value stability. It also depends on where you think mortgage rates might be in the next couple of years. So if you think mortgage rates might be going down in the near term, then you might choose a variable interest rate because you want to take advantage of when those rates do fall. But if you think mortgage rates might be rising in the next couple of years, then you might want to lock in that fixed rate today so that higher interest rates don't affect your monthly repayments when they happen. Now, here's the most important part, the total cost of that mortgage, how much you'll be paying back in total. Sure, the monthly repayments might seem okay for you now, but if you're taking out a 30-year mortgage, then you've got to have some level of confidence that you'll be able to maintain those payments over a 30-year period of time. And remember, mortgages are a long-term thing, so you shouldn't be surprised when you figure out that the total cost of your mortgage, the total amount you'll be paying back over the period of the mortgage, is going to be more than your property is probably worth now. And that's because you don't have that full cash available to pay for that property now. You're taking on a mortgage so you can pay it back on a monthly basis. That interest rate compounds over time, and this compounds in the favor of your lender, your bank, your building society, or whoever you're borrowing money from. But that's okay. You've got to make sure that you can pay back on a monthly basis. The other thing to recognize about mortgages is whether you're paying back on an interest-only basis or on a repayment basis. If you're choosing an interest-only basis mortgage, what this means is that you're only paying back the interest due on your mortgage loan every single month. When it comes to the end of your mortgage term, you'll still be liable for paying back the capital. So let's say you've taken out £100,000 for your property. You need to borrow £100,000 from your bank to be able to buy your property. On an interest-only mortgage, you will be paying interest on that £100,000 each and every month. If your mortgage is for a 20-year term, at the end of that 20 years, you'll still owe the £100,000. Whereas on a repayment mortgage, if you chose the repayment option, on a monthly basis, it might seem more expensive because you're paying your interest every month on that £100,000, but you're also paying a proportion of the capital back. So over a 20-year mortgage term, similar to the last one, you'll have totally paid back everything you owe. You'll have paid the interest over that time, but you'll also have paid back periodically through that 20 years. On a monthly basis, you'll have paid back parts of the capital. So at the end of the 20-year term, you've paid everything back. Now, if I'm buying a property for myself, something I'm going to live in, my family and I are going to live in, I typically always choose the repayment option. It will have higher monthly payments, of course it will, but I like the security of knowing that I'm paying the capital back over that period of time. If I'm buying a property for investment purposes, however, typically I'll be remortgaging throughout the term. I never intend to pay the capital back because I never intend to dispose of the property. And I expect property prices to increase over the long term. And if I ever did need to pay that capital back, for example, if I sold the property, I'm hoping that property is worth more than when I bought it, thereby paying the capital back, but also giving me a bit of a profit. And yes, it is a hope. I hope that property prices will increase over the long term. But this hope is based on data-backed evidence over a long period of time. But again, if it's my property, the one I'm going to live in with my family, then I typically pick a repayment because I think that's a better option and it gives you more assurance that the capital is taken care of over the term of the mortgage as well. So that's a quick 101 into three financial products, three key financial products: credit cards, loans, and mortgages. The key takeaway here is simple. Understanding the terms and being mindful of the costs will save you money over the long run. Don't just accept what you've been offered from the first lender you get introduced to. Remember, these financial tools can work for you if you know how to use them in the right way. But to use them in the right way, you need to understand them. With the right knowledge, you can set yourself up for financial success. But without that knowledge, if you live with your head in the sand, these financial tools can become a burden as well. They can take money away from you each and every month in a way you don't expect and in a way that can cost you far more over the long run. If you have any further questions on credit cards, loans, or mortgages, or you think about a topic that you really would like me to do a video on, then leave a comment below and let me know. And I'll try to make a video on those topics that get the most likes. And just circling back to credit cards, there are two credit cards that I have in my arsenal. And these are the two credit cards that I think everyone should have. If they're not available in your country, there'll be variations of these that are. So shop around and find those that match. And if you want to know which two I think are really, really important for you to have, then take a look at this video next.